It doesn't crash. It doesn't scream. It simply slows, quietly, steadily, with the weight of an empire losing momentum. Welcome to the most invisible crisis of our time. This is FluxFolio Finance, where the story behind the numbers comes alive. For this episode, this is the story of China's great slowdown, not in revolution, but in retreat. For decades, China was the miracle. Its rise was mathematical, relentless, mesmerizing. Hundreds of millions lifted from poverty, sky-high growth. Global supply chains that pulsed with Chinese labor. The engine of globalization. But in 2025, that miracle falters. The numbers tell a new story. China's GDP growth for 2025 has fallen to 4.0%, its lowest level in modern history outside of crisis periods. Consumer prices are in decline, slipping into deflation. Youth unemployment remains at crisis levels. Confidence is evaporating, and yet there's no collapse. That's what makes it dangerous. The United States has imposed up to 245% tariffs on key Chinese exports. In response, China's trade with the US has plummeted by 81%. Factories in Guangdong are slowing. Ports in Shenzhen are emptying. Supply chains are skipping past China, redirecting to Vietnam, India, and Mexico. This isn't deglobalization. It's de-Chinification. China's role as the world's manufacturer is shrinking, not by force, but by design. In an attempt to reignite demand, Beijing in May 2025 injected over $1 trillion, roughly $138 billion, into the banking system by slashing reserve requirements. The benchmark interest rate has dropped to 1.4%, but this isn't stimulus. It's triage. The new credit doesn't reach households. It flows into state-owned banks, into debt-ridden developers, and into zombie infrastructure projects that create GDP but not prosperity. Debt in China is no longer a tool. It's a trap. The official government debt-to-GDP ratio sits near 124%, but when hidden liabilities are counted, off-book local government borrowing, shadow banking obligations, the real number may be closer to 300%. China's fiscal illusion is unraveling, and that number is not sustainable. Beijing's options are narrowing. Too much stimulus risks a currency collapse and capital flight. Too little risks mass unemployment. So the party walks a tightrope of optics, pretending to grow while quietly managing stagnation. The once mighty property sector is a graveyard of unfinished towers and defaulted developers. Evergrande, Country Garden, and dozens more now cast long shadows over middle-class wealth. Mortgages remain unpaid. Apartment prices are falling. Consumer confidence is frozen. Meanwhile, the one-child policy of yesterday is becoming the demographic time bomb of today. In 2025, China's working-age population is shrinking fast. The median age is now approaching that of Western Europe. By 2035, China will lose over 100 million workers. No labor. No consumption. No growth. Efforts to reverse the trend, baby bonuses, housing incentives, have failed. The youth are not responding. Burdened by high living costs, low trust, and dim prospects, millions of young Chinese are simply disengaging. They meme. They ghost. They leave. China's NEET population, young people not in education, employment, or training, has surpassed 20 million. That's a lost generation hiding in plain sight. Social mobility has collapsed. Degrees no longer guarantee jobs. The civil service exam has record applicants, but fewer openings. The frustration is quiet but seismic, and foreign investors see it. In 2025, global capital is pulling out. Foreign direct investment has hit multi-year lows. European firms are relocating. Venture capital is drying up. IPOs are postponed or cancelled. Even the most loyal partners German automakers, US semiconductors, South Korean electronics are hedging bets. The dream of a rising China is quietly fading. And when belief goes, investment follows. This economic retreat doesn't just affect China. It hits everywhere. Commodity prices are falling. Global growth forecasts are being revised down. Emerging markets that depended on China's demand are seeing outflows. Multinational firms that once built entire Asia strategies around China are now hedging into Southeast Asia. This isn't a hard landing. It's a slow erosion. The danger isn't collapse, it's decay. So what should we watch? Credit impulse metrics. These drive domestic demand. Youth unemployment. This tells you where society is going. Property sector defaults, still the backbone of household wealth. Foreign direct investment. If it exits, so does trust. Local government debt rollovers. These will test the real solvency of the state. Migration flows. Talent flight is often the first warning. China's miracle isn't dead, but it is aging. And like all aging giants, it must adapt or become a cautionary tale. The next chapter won't be written in steel and concrete. It will be written in resilience, reform, and whether trust can be rebuilt before stagnation becomes destiny. So here's your FluxFolio perspective. Expect longer-term structural disinflation globally. Expect greater reliance on fiscal stimulus and sovereign debt in EMs. Expect trade and supply chain fragmentation to accelerate. And expect geopolitical risk premiums to rise, as China's weakness invites strategic recalibration from Washington to Tokyo. China's slowdown isn't just economic, it's existential. Thanks for watching FluxFolio Finance. Subscribe, like, and share your thoughts. Is China entering its lost decade, or is it about to surprise us all? Stay global. Stay vigilant. Stay informed.